Everyone keeps talking about stocks, stocks, and stocks, but there's also bonds. Keep watching and let's learn more. Hey everyone, it's Elian at Project Money TV, and I want to thank you for tuning in. Now, in the last video, we talked about stocks, what they are, where they come from, and why people invest in them. In this video, we're going to talk about bonds. But first, I want to throw out a fun fact. Stocks get all the glory in the financial media, but the global bond market is way bigger than the global stock market. In fact, the global stock market is about $80 trillion big, whereas the global bond market is well over $100 trillion in size. So with that said, what's a bond? So I want you to think back to the stock video, where sometimes individual companies need additional money to grow or expand. One of the ways it can get that money is through issuing stock. A company can also borrow money from investors through what's called a bond issue. Now, one thing to note, that it's not just companies that can also borrow money through bond issues. Cities, states, counties, countries, schools, and even individual construction projects like toll roads and bridges can issue bonds in order to fund those projects or their operating costs. Essentially, you become the creditor by giving them your money, and they become the debtor by owing you and needing to pay you that money back. Now, as I just said, over time, the issuing organization is going to pay that money back to you. Now, you're also going to receive interest payments on the money that you lent at predetermined periodic intervals. The interest rate is referred to as the coupon, and the date when the balance is paid back to you, or when the bond expires, is called the bond's maturity date. So here's an example. Let's say that you buy a bond for $2,000 with a coupon rate of 5% and a maturity date 5 years from now. That bond is going to pay you $100 in interest every year for the next 5 years. And in 5 years, when you reach the maturity date, you're going to get the $2,000 back. Now, I also want to point out that it's important to be mindful of the issuer's creditworthiness, because an improperly run organization may not be able to make the interest payments or even pay back the principal, resulting in a very large or total loss of your investment. So why do investors invest in bonds? Well, sometimes bonds may be less risky than stocks, meaning they can help smooth out the ups and downs of the stock market. Also, if you're someone that needs income over potential growth of your investment, high-quality bonds could potentially provide a stream of income over a very long period of time. And a third reason, and it's a little bit more of an advanced reason, but if a public company were to go bankrupt, the bondholders typically have higher priority in getting some, but not all, but some of their investment back in bankruptcy proceedings. Now, if you want to see a cool example of how a bond can pay interest over very long periods of time, take a look at Tom Scott's video on a 369-year-old Dutch water bond that is still paying interest to this day. And I'm going to put the description or the link to that video in the description below. Investing in bonds is relatively easy, as the major brokers all offer some kind of bond offering for their customers. Additionally, even the US government can sell bonds directly to individual investors. And finally, one of the easiest ways to invest in bonds is through a bond mutual fund. So stay tuned, as our next video is going to cover everything that you need to know about mutual funds. So with that said, I hope I provided you a little bit of a basic understanding of what bonds are. If you have any questions, put them in the comments below, and I'll try to answer as many as possible. In the meantime, I'm Elian Mendoza. You're watching Project Money TV, and I encourage you to subscribe, hit the like or dislike button, and thanks for tuning in.